The two smartest things you can do about the SpaceX IPO are buy it or completely ignore it. One of those is a trap, and most people are about to pick the wrong one. On June 12th, 2026, a guy named Logan opened his Robinhood app and bought 4 shares of the most hyped IPO in human history, SpaceX, ticker SPACE, $135 a share. It closed the day up 19%, and he went to bed convinced he'd finally gotten in early on something that mattered. The next morning, his coworker Dana, who has never opened a brokerage app in her life, found out her boring, autopiloted retirement fund had quietly bought the rocket company too. She didn't lift a finger. And here's the part that should bother you. Within a year, Dana's accidental exposure is going to look smarter than Logan's deliberate one. Same company, 2 completely different outcomes. This isn't a story about whether SpaceX is a good investment. It's a story about a quiet rule change that's rewiring your 401k while you stare at the fireworks. And by the time you understand it, the people profiting from it will already be done so. My name is Nick, and I have spent an embarrassing amount of time reading IPO prospectuses and Department of Labor rulemaking documents so that you don't have to, which is either a public service or a cry for help, depending on who you ask. If you've ever logged into your 401k, seen a fund with a name like Target 2055, felt a small flicker of, I really should understand what that is, and then closed the tab and never thought about it again, this is the video where that flicker turns out to matter. Because by the end of this, you're going to know 3 things almost nobody who owns a 401k actually knows. You'll know exactly when SpaceX can legally show up in your retirement account and why it's later than everyone thinks. You'll know why the price your fund eventually pays for it is, in a real sense, already rigged. And you'll know the one phrase to look for in your own plan menu. That means somebody is about to start charging you 20 times more for the privilege of saving for retirement. Because everyone is talking about the SpaceX IPO like it's the story. It's not. The SpaceX IPO is the magic trick. The real move is happening with your retirement money, and almost nobody is watching the right hand. So let's start with what actually happened, because the headlines got it about half right, which is somehow worse than getting it all wrong. On June 11th, SpaceX priced its IPO. The next day, it started trading on the NASDAQ under the ticker SPACE, and the numbers are genuinely absurd. They priced it at $135 a share. They sold about 555 million shares. They raised somewhere in the neighborhood of $75 billion, and that put the total value of the company at roughly $1.77 trillion. Trillion with a T. Let me put that in perspective. That's a valuation bigger than the entire economy of most countries on Earth. It's the largest IPO that has ever happened by a mile. The previous record holders aren't even in the same area code, and the way they did it was peak Elon. A normal IPO has this whole song and dance where bankers set a price range, go on a roadshow, take the temperature of big investors, and nudge the number around for weeks. SpaceX skipped all of that. They handed the market a single number, $135, take it or leave it, and the market took it. The deal was something like 2 times oversubscribed, with reported demand around $250 billion for a deal a fraction of that size. By the close of the first week, it had already comfortably settled above the $2 trillion mark, making it the most valuable debut in history. So whatever else you want to say about this, the appetite was real. People wanted in so badly they were practically clawing at the doors. Now here's the part that made this IPO different from every mega IPO before it, and it's the part that matters for you specifically. Normally, when a giant company goes public, regular people get crumbs. The big institutions get the shares at the IPO price, and by the time you and I can buy, the stock has already popped and we're paying the marked up price. SpaceX flipped that. They set aside roughly 30% of the available shares, about $22.5 billion worth, specifically for retail investors, for normal people, through Robinhood, Fidelity, Schwab, SoFi. That is roughly 3 times the slice retail usually gets in a deal this size. So our friend Logan, opening his app at 9:30 in the morning, actually could get in near the ground floor, which feels like a gift. Hold that thought because we're going to come back to whether it actually was one. So that's the spectacle, biggest IPO ever, retail invited to the party. The stock pops 19% on day one. And if you stopped watching right there, you'd think this story is simple. SpaceX is public, everyone can buy it, the end. But that's exactly where most people get the next part completely wrong. Because here's the question nobody's actually answering. Does any of this touch your 401k? And the answer is the most frustrating answer in all of finance. Not yet. And maybe not the way you think. Let me explain why, because this is where it gets genuinely interesting. And by interesting, I mean mildly infuriating. Most people's retirement money is in index funds. Specifically, a huge chunk of it is in S&P 500 funds and total market funds and target date funds, which are the ones with a year in the name like Target 2055 that automatically adjust as you age. If you have a 401k and you've never customized it, there is an excellent chance your money is sitting in one of these right now on autopilot, owning what the index owns. And the magic of these funds, the entire reason they're so good for regular people is that you don't pick anything. You own the market. When a company is in the index, you own a slice of it automatically. You, like Dana, don't lift a finger. So the natural assumption is, okay, SpaceX is now a giant public company. It'll just get added to the S&P 500 and then my index fund will own it and I'll get my little piece of the rocket. Simple, except the S&P 500 is not what you think it is. Here's the thing nobody tells you. The S&P 500 is not just the 500 biggest companies in America. It's a club. It has a bouncer. There's an actual committee of human beings at a company called S&P Dow Jones Indices. And they decide who gets in. And they have rules, real rules. And one of those rules just slammed the door directly in SpaceX's face. To get into the S&P 500, you have to clear a few bars. You need a market cap above a certain threshold, currently around $22.7 billion. SpaceX clears that one by about 70,000%, so no problem there. You need enough of your shares to be publicly traded. You need to have been public for at least 12 months, what they call seasoning. And here's the killer, you need to be profitable. Specifically, you need positive earnings in your most recent quarter and positive earnings when you add up the last 4 quarters. Real accounting standard, bottom line profit. And SpaceX reported a staggering net loss of $4.9 billion in 2025. Let me say that again, because when people hear SpaceX, they picture a money printer. In 2025, the company lost almost $5 billion on paper. Now, I want to be fair and precise here because this is the kind of thing that gets distorted into nonsense. That loss is not because the rockets don't work or Starlink isn't selling. Starlink is wildly profitable. We'll get to that. The loss is mostly an artifact of the absolutely insane amount of money they're pouring into AI infrastructure and the XAI merger, capital expenditures north of $20 billion in a single year. So it's not a sign the business is failing. But the S&P 500's profitability rule does not care about your nuance. It does not care why you lost money. It looks at the bottom line, sees a negative number, and says, come back when you're profitable. So SpaceX, the biggest IPO in history, the most valuable company in the world, is locked out of the S&P 500, which means it is locked out of the index funds where most of your retirement money lives. And I want to pause on that loss for a second because it's the kind of detail that sounds like a scandal and is actually the opposite, and the difference matters. When you hear SpaceX lost $5 billion, your brain files it next to companies that lose money because nobody wants what they sell. That is not what's happening here. Underneath that headline loss are 2 completely different businesses wearing the same logo. There's the rocket business, which launches more mass into orbit than every other entity on the planet combined. And then there's Starlink, the satellite internet business, and Starlink is quietly one of the best businesses on Earth right now. $11+ billion in revenue last year, growing close to 50%. Over 10 million subscribers in 160 countries, $4+ billion in operating profit. by itself, Starlink is a profit machine. If Starlink were the whole company, SpaceX would sail into the S&P 500 without breaking a sweat. So why the $5 billion loss? Because they took all that beautiful Starlink profit and a mountain of investor cash on top of it and shoveled it into the most expensive science fiction project of our lifetime. Capital expenditures north of $20 billion in a single year, a huge slug of it going into AI infrastructure and the XAI merger. In accounting terms, that spending creates a loss. In strategic terms, it's a company deliberately choosing to look unprofitable today in order to own the future tomorrow. Whether that bet pays off is a genuinely open question. But here's the thing for our purposes. The S&P 500's profitability rule cannot tell the difference between losing money because the business is broken and losing money on purpose because you're building the future. It just sees a negative number and says no, which is why the most valuable company in the world is standing outside the most important club in finance, holding a $5 billion receipt for the future, unable to get past the bouncer. Now, you might be thinking, okay, Nick, but surely they'll just change the rules. It's the most valuable company on the planet. The committee will make an exception. And that is a completely reasonable thing to assume. It's also exactly what a lot of very smart Wall Street people assumed. They were wrong. Here's what actually happened, and this is the hard news at the center of this whole story. Earlier this year, S&P Dow Jones indices actually floated the idea of changing the rules. They opened up a public consultation. They proposed cutting that 12-month seasoning period in half down to 6 months, and more importantly, they proposed waiving the profitability requirement for mega cap companies, and they were not subtle about why. Everyone understood this was the let the giant private companies in rule. SpaceX, OpenAI, Anthropic, the whole new class of trillion-dollar babies that are unprofitable on paper because they're spending like maniacs to build the future. And then on June 4th, 2026, after something like 20,000 public comments, S&P said no. They rejected it. They kept the profitability screen. They kept the seasoning period. They basically said, and I'm paraphrasing only slightly, being enormous is not a substitute for being profitable, and we're not handing out exceptions just because you're big. Which, honestly, respect. In a world where everyone bends the rules for the biggest player in the room, a committee of index nerds just looked at the most valuable company on Earth and said, wait your turn. What does that mean for you in plain English? It means SpaceX cannot get into the S&P 500 until it strings together 4 straight quarters of actual profit and clears the seasoning period, which puts the earliest possible date somewhere in 2027, and that's the optimistic version, the one where they flip to profitability fast. So if your retirement money is in an S&P 500 fund, you do not own SpaceX today. You will not own it tomorrow. You might own it in a year or two if a lot of things go right. The rocket went public, and your index fund still can't touch it. Now here's where I have to give Dana, our accidental investor, a little asterisk because I set this up and I owe you the honest version. Not every index is the S&P 500. There are other clubs with looser bouncers. The NASDAQ 100, for example, has a fast entry rule that can pull in a big new listing within about 15 trading days, and it doesn't have that brutal profitability screen. The MSCI indexes moved fast too. So if Dana's target date fund happens to hold a NASDAQ 100 piece or some international index exposure, she might have caught a sliver of SpaceX within weeks. That's the asterisk. But for the single biggest bucket of American retirement money, the plain old S&P 500 index fund, the door is shut until at least 2027. Most people genuinely do not know this. They think public means in your 401k. It doesn't. Public means eligible to maybe eventually, after clearing a bunch of hurdles, possibly end up in your 401k. Those are very different sentences. So let's sit in that gap for a second, because the gap is the whole point. There's the thing you think is happening. SpaceX is in my retirement account now. And there's the thing that's actually happening, which is almost nothing, at least directly, at least for a while. And in that gap between perception and reality, a much bigger and much sneakier change is taking place. And this one absolutely will end up in your 401k. This is the part you're not ready for. Let me show you what I mean by walking through how this normally goes, because there's a beautiful slow machine that kicks in when a giant company finally does qualify for the index. And understanding it tells you everything about why your retirement account moves the way it does. When a company finally gets added to the S&P 500, something wild happens. Every single index fund on the planet that tracks the S&P 500 is contractually, mechanically required to go buy that company's stock. They have no choice. Their entire job is to match the index. So the second the index includes a new name, billions of dollars of forced buying kicks in. Not because anyone decided the company is a good investment that week, purely because the rules say so. The best example of this in living memory is Tesla. Stick with me, because the Tesla story is basically a preview of the SpaceX story just a few years early. Tesla qualified for the S&P 500 back in 2020 after it finally put together its fourth straight profitable quarter. And when they announced Tesla was getting added in December of 2020, the index funds had to buy. We're talking an estimated $80+ billion of Tesla stock that funds had to scoop up basically all at once to match the new index. Like, some estimates of the total buying pressure went well north of 200 billion. It was the single largest addition to the index in history at the time. And here's the kicker. Because everyone knew the forced buying was coming, Tesla's stock ran up something like 40% between the announcement and the actual inclusion date. Traders front ran the index funds. They bought ahead of the wave, knowing the wave was guaranteed to come. Now apply that to SpaceX. Thought when, and it's a when, not an if, assuming they get profitable, SpaceX eventually qualifies for the S&P 500. The exact same machine fires up. Every S&P 500 index fund on Earth, holding trillions of dollars of America's retirement savings, will be forced to buy SpaceX. Some estimates put the eventual mechanical buying across all the indexes at over $100 billion, and a big chunk of that buying happens with your money automatically on autopilot, the same way Dana's fund works. You won't get a notification. You won't make a decision. One day, SpaceX just quietly appears in your portfolio, and your fund bought it at whatever price it was trading at that day, high or low, because the rules said it had to. And this is the first thing most people are not ready for. Not that SpaceX is in your 401k now, it isn't, but that when it does arrive, you have zero control over the price you pay for it. The index doesn't buy low. The index buys whenever the rules say to buy. If SpaceX is overpriced on inclusion day, congratulations, your retirement fund overpaid and you never got a vote. There's a second piece of this calendar that nobody's pricing in, and it's worth understanding because it's basically a slow motion event you can see coming. When a company IPOs, the insiders, the employees, and early investors holding mountains of stock are not allowed to sell right away. They're locked up. SpaceX used a tiered lockup, which is a fancy way of saying the floodgates open in stages over the months following the IPO, with big chunks of insider stock becoming sellable after each earnings report, and the largest releases hitting around the 6-month mark, roughly December of 2026. Elon himself and certain major investors are locked up even longer, a full year, out to the middle of 2027. Why does that matter to you? Because history says lockup expirations are dangerous moments for a stock. When Rivian's insiders got cleared to sell, the stock dropped something like 20% in a day. Uber hit an all-time low around its lockup expiry. Palantir fell 13% in a single session when early backers started cashing out. The reason is simple: supply and demand. Suddenly there's a flood of new shares hitting the market from people who've been waiting years to sell, and at the IPO, only about 4 or 5% of SpaceX was actually trading freely, so you've got a tiny float, sky-high demand, and a calendar full of scheduled moments where insiders are finally allowed to dump. That's a recipe for some genuinely wild price swings between now and the middle of 2027. And remember, if SpaceX happens to qualify for the index during one of those high or low swings, your fund buys at that price, not the fair price. That price, the calendar, not the value, decides. So hold on to that, because so far everything I've described is the normal machinery. Slow, mechanical, rule-bound, kind of boring in a reassuring way. Companies go public, eventually they qualify, eventually the index buys them, eventually you own them. It's a system with breaks. The profitability rule is a break. The seasoning period is a break. The whole thing is designed to keep wildly speculative, unproven, money-losing companies out of grandma's retirement account until they've proven they can actually make money. Every safeguard we just walked through exists to protect you. Now, let me tell you about the executive order that's quietly cutting every one of those brake lines at the same time. This is the part you're actually not ready for, because while everyone's been staring at the rocket, there's been a completely separate story unfolding in Washington, and it is the actual reason I made this video. In August of 2025, an executive order was signed with the friendliest, most harmless sounding name you could possibly imagine. Democratizing access to alternative assets for 401k investors. Democratizing, doesn't that sound nice? Who could be against democracy? Who could be against access? It sounds like they're handing you the keys to the kingdom. Here's what it actually does. It directs the Department of Labor and the SEC to crack open your 401k and let in a whole category of investments that have always been kept out. Private equity, private credit, real estate funds, infrastructure deals, and critically for our story, stakes in private pre-IPO companies. The exact kind of thing SpaceX was for the last 20 years before it went public. For your entire life, your 401k has basically been allowed to hold public stocks and bonds. Boring, transparent, liquid stuff you can price every single day and sell in about 3 seconds. That wasn't an accident, that was a guardrail. There's a law called ERISA that governs retirement plans, and it requires the people running your 401k to act as fiduciaries, which is a fancy legal word that means they're legally required to put your interests first, to be prudent, to not gamble your retirement on stuff they don't understand. And for decades, that duty plus the fear of getting sued kept the weird, expensive, hard to price stuff out of your retirement account. The guardrail was doing its job. This executive order is designed to lower that guardrail, and the scale of what's at stake is enormous. We're talking about a system with more than $12 trillion in it, covering something like 85 million American workers. And I know 85 million workers is the kind of number that just slides right off your brain. So let me make it personal. If you have a 401k, a 403b, a workplace retirement plan of basically any kind, you are not watching this happen to other people. You are one of the 85 million. The $12 trillion they're talking about includes the few thousand or few 100,000 sitting in your account right now. That is the prize. That is what the alternative asset industry has been staring at, slack-jawed for years. $12 trillion of retirement money, yours included, that they have never been allowed to touch. And now the door is being propped open. Let me reintroduce someone, because I don't want this to feel abstract. Remember Dana, our accidental SpaceX investor, the one whose target date fund quietly does the right thing while she ignores it? It's like Dana is exactly who this change is aimed at. Not because anyone's going to ask Dana what she wants. That's the whole point. Dana never picks her investments. She's defaulted into a target date fund like the overwhelming majority of people. And if private assets get baked into that default target date fund, then Dana owns them automatically, the same way she accidentally owned a sliver of the index. Except this time, the thing she's automatically buying isn't a transparent, liquid, penny-cheap index fund. It's an expensive, hard-to-price, hard-to-sell private fund. And she will have agreed to exactly none of it. Now, I try really hard on this channel not to be the guy yelling that everything is a conspiracy, because most of the time it's not a conspiracy, it's just incentives. So, let me be fair and steelman the other side, because there's a real argument here. The argument for this goes like this. For decades, regular people have been locked out of the best performing, fastest growing investments in the entire economy. Think about it. Every story we just told about SpaceX, the rise from a $137 billion company to a $1.77 trillion company, that massive 13-fold explosion in value, all happened while SpaceX was private, while normal people were legally not allowed to invest in it. The big gains were captured by venture capital firms and a tiny handful of wealthy, connected insiders. By the time you and I were allowed to buy at the IPO, the easy money was already made. So the pitch is, isn't that unfair? Shouldn't regular people get access to that growth too? Shouldn't Dana get a shot at the next SpaceX while it's still small, instead of always buying in at the top? And honestly, said like that, it's a compelling argument. The biggest financial firms in the world, BlackRock, Apollo, Blackstone, are all making exactly this case. BlackRock even put out research claiming that adding private assets could add about 0.5% of return per year, which compounded over a 40-year career, they say, could mean roughly 15% more money at retirement. 15% more. That's a real number. That would change lives. So that's the bull case. And if it were that simple, I'd be all for it. But it's not that simple. It's never that simple. So let me show you the other side of this, the side that doesn't make it into the friendly executive order title. There are 3 problems and they stack on top of each other. The first problem is fees, and this is the one that should make you genuinely angry, because this is the one that quietly steals from you over decades. Your boring S&P 500 index fund, the one we've been talking about, charges you something like 3 to 8 1/100% per year. Basically nothing. A few bucks a year per $10,000 invested. That's one of the great miracles of modern finance. Honestly, you get to own the entire American economy for the price of a pack of gum. The private funds they want to put into your 401k, those are expected to charge somewhere between 1% and 1.6% per year. And the classic private equity fee structure is even more brutal. The infamous 2 and 20, 2% of your money every single year, whether they make you a dime or not, plus 20% of any profits on top. Heads, they win. Tails, they also win. You're just there to hold the chips. Let me make that real, because percentages are slippery and your brain glides right over them. Let me show you some math that might genuinely change how you think about this. Imagine you have $100,000 in your retirement account and it grows at 7% a year for 30 years with a near zero fee index fund, the kind you can buy today. That 100 grand turns into roughly $750,000, $750,000. Beautiful. Now run the exact same scenario, same starting amount, same gross returns, but with a 2% annual fee dragging on it the whole way. That same $100,000 grows to about $430,000. Look at that gap on screen right now, because that gap is the entire pitch. The fee didn't cost you 2%. The fee cost you $320,000, more than 40% of what you should have ended up with gone. Vaporized, transferred quietly year after year from your retirement to someone else's bonus. And I want to be precise here, because that math actually assumes the private fund earns the same gross return as the index. The fee drag alone eats 40% of your money, even if the private fund performs identically to a cheap index fund. The Department of Labor itself, in its own official guidance, points out that just a 1% difference in fees can shrink your final balance by about 28% over a career. 1%. And these funds want to charge you more than 1%. They want to charge you way more. So that's problem 1. The fees are a slow motion robbery, and the victim doesn't even feel the hand in their pocket because it happens a fraction of a percent at a time for 40 years. Or the second problem is that you can't get your money out. With an index fund, if you need your money, you sell it today, right now. The market's open, you click a button, you have cash. That's called liquidity, and it's something you don't appreciate until it's gone. Private assets are the opposite. Your money can be locked up for years. There's no daily market, no button to click. Some of these vehicles only let you redeem your money at certain windows a few times a year, and sometimes not even then, if too many people want out at once. So picture this. The market crashes, you lose your job, you need cash, and you go to pull money from your retirement account, and a chunk of it is stuck in a private fund that says, sorry, the redemption window is closed, check back next quarter, which is a wonderful sentence to hear from your own money. It's like your savings account looking you in the eye during an emergency and saying, I'm going to need you to schedule an appointment. That's not a hypothetical. That's how these things actually work. Illiquidity is a feature, not a bug for the people running the fund. It's a problem for you at the exact worst moment. And the third problem is the sneakiest, and it's the one that ties this whole video together. It's the problem of what you're actually buying and when you're buying it. Here's the uncomfortable truth at the center of this whole democratization pitch. They are opening the gates to private markets right at the moment when the easy money has already been made. Think back to SpaceX. The people who made the truly life-changing returns were the ones who got in at the very beginning. There's a venture firm called Founders Fund that put in about $20 million back in 2008 when SpaceX was a few failed rocket launches away from going bankrupt. That stake was reportedly worth more than $50 billion by the IPO. 20 million to 50 billion. That is a 2,500 times return. That is generational, dynasty founding, never work again money. Now, was that opportunity ever going to be offered to Dana's 401k? Of course not. Nobody puts a pre-bankruptcy rocket startup into grandma's retirement fund. By the time a private company is safe enough and mature enough to be dropped into millions of retirement accounts, it's not a tiny $20 million bet anymore. It's a $1.77 trillion behemoth that already had its 62,000% run in private with the regular public locked outside the gate. So when they finally invite you in, you're not getting the early explosive part of the growth. You're getting the late, slow, expensive part. You're not the early investor. You're the exit. You're the person the early investors sell to so they can cash out. And that right there is the single most important idea in this entire video. So let me say it as plainly as I possibly can. The system spent the last 20 years moving all the best growth behind a wall that regular people weren't allowed to climb. And now that the growth on the other side of that wall has mostly already happened, they're knocking down the wall and calling it a gift. They're not giving you access to the upside. They're giving you access to the part that's left over after the people in the know already took theirs. Let me give you a number that drives this home because it's almost funny. When SpaceX priced its IPO at $135 a share, that valued the company at roughly 94 times its annual revenue. 94 times revenue. For context, that is a multiple with basically no precedent among the most valuable companies in the world. One respected research shop, Morningstar, looked at the actual business, the rockets, the Starlink subscriptions, all of it, and pegged what they thought the company was really worth at closer to $780 billion. The IPO price implied $1.77 trillion. So by that estimate, retail investors, our friend Logan and everyone like him, were buying in at more than double what the underlying business might actually be worth. Some analysts came right out and said it. The IPO looked less like an on-ramp for regular investors and more like an off-ramp for the early ones, a beautifully engineered exit. Now, I'm not telling you SpaceX is a bad company. It is an astonishing company. We already talked about Starlink beaming internet down from space to places that never had it. The engineering is real. The business is real. I'm not dunking on the rocket. What I'm telling you is that the price you pay for a great company is a completely separate question from whether the company is great. The best business on earth is a bad investment if you overpay for it. And the entire machinery we've been describing, the index inclusion, the forced buying, the private asset in your 401k shift, all of it is designed to get you to buy mechanically, automatically, without ever asking the only question that actually matters, which is, at this price, is this a good deal for me? But SpaceX is just one company, and if I left you thinking this is only about one rocket company and one fee structure, I'd be doing you a disservice, because the thing I'm about to show you is happening to the entire stock market quietly over decades, and once you see it, you genuinely cannot unsee it. Here is a statistic that, once you see it, you can't unsee. Back in the mid 1990s, there were around 8,000 publicly traded companies in the United States. Today, there are roughly 4,000. The number of public companies got cut in half. And it's not because America stopped building companies. We're building more than ever. It's that they're staying private. They're staying private longer, and they're getting absolutely enormous before they ever let the public buy in. In 1999, the typical company went public when it was about 5 years old. By 2025, that had stretched to about 12 years. The companies wait twice as long, get many times bigger, and capture all that growth privately before the public ever gets a seat. Even Jamie Dimon, who runs JP Morgan and is about as establishment as a human being can get, has basically said this is backwards, that the number of public companies should be growing, not shrinking. When the guy at the top of the financial food chain is uneasy about it, that tells you something. So put the whole picture together. Public markets, the place where regular people are actually allowed to invest, have been shrinking for 30 years. The best growth has been migrating into private markets where you're not allowed. The accredited investor rule, which says you basically need $1 million net worth or a $200,000 income to play in private markets, has kept the gate locked for everyone else. The logic apparently being that having $1 million makes you immune to bad decisions, which is going to be genuinely surprising news to anyone who has ever met a millionaire. And now, finally, they're unlocking the gate and pushing private assets toward your 401k. But they're doing it at the most expensive, latest stage, lowest upside, highest fee moment in the cycle. The access is real. The timing is terrible, and the timing was never an accident. Okay? I've been hammering you with some heavy stuff, so let me pull back and tell you who the actual players are here. Because once you see who's pushing this, the motives get really clear, really fast. On one side, you've got the asset managers. BlackRock, the biggest money manager on the planet. Apollo and Blackstone, two of the giants of private equity. Empower, which is one of the largest companies that actually runs 401k plans for employers. These firms have all lined up, formed partnerships, and started building products specifically designed to funnel private assets into retirement accounts. BlackRock's CEO, Larry Fink, has been openly pitching a future where the classic 60-40 portfolio, 60% stocks and 40% bonds, becomes a 50-30-20 portfolio, with that last 20% in private assets. Empower's CEO put it almost poetically. He said the 401k once democratized access to the public markets, and now we're facing a similar moment. Which sounds inspiring until you remember that these companies make dramatically more money on a 1.5% private fund than they do on a 3 basis point index fund. The enthusiasm is real. So is the math behind the enthusiasm. And on the other side, you've got the skeptics, and they are not who you'd expect. You've got senators from both ends of the political spectrum raising the alarm. Elizabeth Warren wrote pointed letters to these companies, essentially asking, and I'm summarizing, explain to me how dumping people's life savings into risky, expensive, opaque private markets helps anyone other than the people running the private funds. Bernie Sanders signed on too. You've got the SEC's own investor advocate office saying they're going to study this. So this isn't a left versus right thing. This is a The people whose job is to protect regular investors are nervous thing. When Elizabeth Warren and a Trump executive order are on opposite sides of an issue about your money, it's at least worth slowing down and reading the fine print. Now let me show you the workaround that already exists, because while we wait for the 401k door to fully open, a bunch of companies have already built side doors for retail investors who are desperate to own a piece of SpaceX right now. And these side doors are a perfect tiny preview of exactly the problem we've been describing. They are a warning label you can read today. The most famous one is a fund that trades under the ticker DXYZ, run by a company called Destiny. It's a closed-end fund, and SpaceX is its single biggest holding, around 16% of the fund. Sounds great, right? There's a simple way to own SpaceX through your regular brokerage account. Here's the catch, and it is a spectacular catch. This fund has spent much of its life trading at an insane premium to the actual value of the stuff it holds. At one point, the fund was trading at a price more than 200% above the value of its underlying assets. In its very first month of trading, the premium briefly hit over 2,000%. Let me translate that into human terms. You were paying $3, sometimes more, for $1 worth of actual SpaceX exposure. One analyst ran the comparison and found that getting your SpaceX exposure through this fund could cost you something like 9 times more than getting the same exposure another way. Morningstar, not known for spicy language, basically said the fund lets investors enrich others at the expense of themselves. That's about as close to a financial obituary as those people get. There are other vehicles. There's an ARK fund run by Kathy Wood's shop, where SpaceX is the top holding. It's what's called an interval fund, which means, you guessed it, you can't just sell whenever you want. And its expense ratio is around 2.9% a year. Remember our fee math? 2.9% a year is the kind of drag that over a few decades eats a massive chunk of your returns, even if the fund picks brilliantly. There's a Barron fund that's basically a leveraged bet on Elon, around a third SpaceX, a fifth Tesla. Each of these is a real way to get exposure. Each of them comes with a catch that you, the retail investor, are paying for. Premiums, lockups, fees, always the same 3 problems in different outfits. And these side door funds tell you something important about the main event. They show you what happens when there's huge retail demand for a private asset and not enough supply. People get so hungry to own the thing that they'll pay 2, 3, 9 times what it's actually worth just to feel like they're in. Yeah, that same desperate hunger to not be left out is exactly what the 401k change is going to tap into, except at a scale of $12 trillion and mostly on autopilot, where you won't even feel yourself reaching for your wallet. So let me bring this all the way back to Logan and Dana, because I promised you at the start that her lazy, accidental approach was going to end up looking smarter than his confident, deliberate one, and I owe you the payoff. Logan did what feels smart. He saw the biggest story in finance. He had the chance to get in on day one at the IPO price, and he took it. He bought 4 shares at $135. He's proud of it, and he might do fine. SpaceX might grow into its valuation over the next decade and prove all the skeptics wrong. That genuinely could happen. But here's what Logan actually did. Underneath the excitement, he bought a single company at 94 times revenue at a price that one serious analyst thinks is double what the business is worth. At the exact moment the earliest investors were cashing out their 62,000% gains. He put his money in at the top of the value curve and called it getting in early. He's not necessarily wrong to be excited, but he's paying retail price for a ticket the insiders already used. And if you think that 19% first day pop proves Logan was right, let me show you what first day pops are actually worth, because the history here is brutal and weirdly consistent. When Facebook went public, the stock barely moved on day one, then fell so hard over the following months that people called it a disaster, and it didn't get added to the S&P 500 for about 19 months. It went on to become one of the great stocks of the decade, but you'd have had to white knuckle through an ugly first year to find out. When Uber went public, it closed down almost 8% on day one, the biggest first day dollar loss in American history at the time. When Airbnb went public, it more than doubled on day one, which felt amazing. Right up until you realize anyone who bought at that euphoric opening price paid a fortune. And Rivian, the one we already met at its lockup expiry, opened so high that it was briefly worth more than Ford and General Motors, two companies that, actually make and sell millions of cars. Within about a year, it had fallen something like 80 to 90% from its IPO price. The pattern is almost a law of nature. The day one pop tells you about hype. It tells you almost nothing about whether you bought at a good price. And even the genuine winners made you wait more than a year and a half before the index, and your 401k would touch them. SpaceX is on that exact same clock, and that clock has barely started ticking. Dana did something that looks dumb and is actually wise. She owns the whole market. Thousands of companies automatically rebalanced. At a fee so low, it's almost a rounding error. She never tried to pick the winner, so she can never catastrophically pick the loser. When SpaceX eventually qualifies for the index, if it does, her fund will buy it in proportion as one small slice of thousands. And if it soars, she wins a little, and if it craters, she barely feels it. She's not trying to be a genius. She's trying to not need to be a genius. And over 30 years, not needing to be a genius beats trying to be one almost every single time. And here's the twist on the twist. Dana's beautiful, lazy, low-cost strategy only works as long as her default fund stays cheap and simple, and that is precisely what the private asset push threatens. If the democratization movement succeeds and private equity gets baked into the default target date funds, then Dana's effortless 3 basis point miracle quietly mutates into a 1.5% fee machine full of stuff she can't sell and can't price. The exact thing that makes her approach work, the low cost and the simplicity, is the thing on the chopping block. She didn't opt into that. Nobody asked her. It just arrived in the default, the same way the index quietly arrives, except this time the quiet arrival is working against her. So this was never really a video about a rocket. The rocket is the distraction. This is a video about who controls what ends up in your retirement account and whether the changes being made in your name are actually being made in your interest. So what do you actually do with all of this? Because I don't want to just dump a pile of anxiety on you and walk away. That's not the point. The point is to hand you back some control, because the entire machinery we've described works best on people who aren't paying attention. First, and this is so simple it sounds stupid, go look at your 401k, actually log in. I know, nobody wants to, but go find out what you're actually invested in and what you're paying for it. Find the expense ratio. If you're in a basic index fund or a low-cost target date fund paying under about 0.2%, you are in great shape, and your main job is to protect that. If you see fees creeping up or new alternative or private options showing up in your plan menu, that's your signal to read carefully before clicking anything. Second, understand that new access is not the same as good deal. When your plan eventually offers you private equity or pre-IPO funds or some shiny alternative bucket, and the marketing is going to be incredible. It's going to use words like exclusive and sophisticated and democratized. Your job is to translate every one of those words back into the only language that matters. What does it cost? Can I sell it when I need to? And am I buying the early growth or the leftovers? Run it through those 3 filters every time. Third, separate the company from the price forever in every investment you ever make. SpaceX is a phenomenal company. At 94 times revenue, it might still be a phenomenal company and a terrible investment at the same time. Those are 2 different questions, and the whole system is designed to get you to answer the first one. Is it a great company? And never ask the second one. Is it a great price? Always ask the second one. It's the only one your bank account cares about. And fourth, respect what boring already gives you. The low-cost index fund, the thing that's been quietly compounding in the background while you ignored it, is one of the most powerful wealth-building tools ever made available to a regular person. The democratization pitch is essentially a campaign to convince you that boring isn't good enough, that you deserve access to the exciting stuff. But for most people, for most of history, the exciting stuff is where the wealth goes to die. Boring is the cheat code. Don't let anyone shame you out of it with a pretty word like access. Look, the SpaceX IPO is genuinely a historic moment. It's the biggest IPO ever. It minted a couple $1 trillion in value, and watching humanity build reusable rockets and beam internet from space is honestly one of the more inspiring things happening on this planet right now. I'm not cynical about the rocket. I'm cynical about the machinery that's been built around it and about a change to your retirement account that arrived dressed up as a favor. Here's the thing I really want you to hold on to. The people who push these changes are counting on a very specific thing. They're counting on you not paying attention. They're counting on you seeing the headline, feeling the fear of missing out, and either rushing in like Logan or zoning out like Dana on a day when zoning out is the wrong move. The entire game is played in the gap between what's actually happening and what you think is happening, and you just spent the last 20 some minutes closing that gap. You now understand more about how your retirement money actually moves than the overwhelming majority of people who own a 401k. That's not nothing. That's the whole ball game, actually, because you can't be quietly taken advantage of by a system you understand. And that honestly is the only edge regular people have ever had. Not more money than the insiders, not better timing, just paying attention on the days everyone else looks away. You did that today. So whatever you do with the rest of this, you're already ahead of where you were 20 minutes ago. Oh, and one more thing, since I get asked this constantly, a bunch of you keep asking how I actually research and break down stuff like this. The IPO filings, the rule changes, the boring documents nobody reads. So I put together a completely free community where I walk through exactly how I build a faceless YouTube channel like this one from scratch, the research process, the scripting, the whole system I use to turn dense financial topics into videos people actually watch. If that's something you've been curious about, especially because honestly, YouTube is one of the great underrated opportunities right now. If you do it properly, come hang out. I'll leave it linked, and I'm genuinely happy to help you get started. Either way, do me a favor this week, log into that retirement account, read the fine print before the fine print starts reading you. The rocket's going to be fine. The question is whether you are. And as always, just a quick reminder, I'm not a financial advisor and none of this is financial advice. It's just me doing way too much math for educational purposes only. What you do with your own money is on you. Make it count.